Imagine a pharmaceutical company based in Indiana,
Okay.
but their most critical, cutting-edge manufacturing floor isn't located anywhere in the Midwest.
Where is it?
It is actually floating 250 miles above your head in low Earth orbit.
Wow. Yeah.
Today, the conversation around the space economy is, well, it's no longer just about science fiction,
Oh,
or exploration for the sake of human curiosity.
right. It's totally shifted.
Exactly. It has fundamentally morphed into this unbelievably capital-intensive, heavy industry. We're talking about, like, pouring concrete, securing defense supply chains, and executing massive manufacturing contracts.
And that transition from theoretical exploration to heavy industrialization, it just requires a staggering amount of upfront capital,
Yeah.
which, as you can imagine, creates some incredibly volatile market dynamics.
Which brings us to the mission for today's deep dive. For you, the listener, trying to cut through all the noise out there, we have basically compiled a stack of financial data, market sentiment analysis, and recent news reports.
All centered entirely on one specific company.
Right. Redwire. Our goal today is to unravel a massive contradiction sitting right at the center of their valuation.
And it is quite the contradiction.
It really is. I mean, Redwire stock has plummeted over 67% from its 52-week high. It has taken an absolute beating in the public markets.
Brutal.
But yet, simultaneously, their revenue is exploding by nearly 60%, and they are sitting on a record-breaking defense backlog.
Yeah, the numbers are wild.
So the core mystery we need to solve is this, right? Is the broader market completely mispricing this company's future monopoly power, or are investors accurately pricing in a looming catastrophic financial risk?
It really is the ultimate Rorschach test for growth investors right now.
Totally.
If you look at the exact same financial filings, I mean, you can build a highly convincing case for a generational buying opportunity. Or, you can build an equally convincing case that this is just a total financial black hole.
Okay, let's unpack this paradox, starting with the sheer scale of the top-line growth. Because the numbers here are aggressive. According to the latest reports, Redwire's Q1 2026 revenue jumped 58% year over year. That is hypergrowth territory usually reserved for, like, flashy software companies.
Not aerospace manufacturing.
Exactly. And their trailing 12-month revenue growth is sitting at a very impressive 33.58%.
Right.
They currently have a market capitalization of $2.07 billion, and they're trading at a price-to-sales ratio of 5.59 with a price-to-book of 1.78.
To put that 5.59 price-to-sales ratio into context for you, if this were a standard tech or SaaS company with minimal overhead, a multiple of 5.5 times sales might be considered, relatively cheap.
Right, a bargain.
But for a heavy industry manufacturer that actually has to build physical hardware to survive, investors paying nearly 6 times revenue are paying a massive premium.
Yeah.
They are paying purely for the potential of what those sales might become in the future.
Because the present reality of those sales is, well, it's where the nightmare begins.
It gets ugly.
The trailing 12-month gross margin is barely surviving at 9.18%.
Yikes.
But the net margin is what really stops you in your tracks. It's an absolutely abysmal negative 80.9%.
Yeah, that is a tough pill to swallow.
And their trailing 12-month earnings per share is sitting at negative $2.26. Think about this like building an offshore oil rig.
Okay, I like that analogy.
The oil is down there, the global demand is massive, and you have buyers lined up. But the upfront cost to build a rig capable of withstanding a hurricane is so astronomical that you are just drowning in debt for years.
Right, before the first profitable barrel is ever pumped.
Exactly. I look at this negative 80.9% net margin, and I just have to ask, how long can management defend an $8.69 stock price on a promise of future efficiency?
Well,
I mean, a business can only bleed 80 cents on every dollar for so long before the music stops, right?
right, and management is acutely aware of that ticking clock, which is why they are desperately trying to pivot the entire corporate identity right now.
How so?
They are trying to transition from a narrative-driven growth story where you basically sell the utopian dream of a space economy into an execution-driven story.
Oh, I see.
They have to prove to the institutional money that they can actually scale operations and squeeze sustainable free cash flow out of that record backlog.
So they have to show they can actually build this stuff profitably.
Exactly. The reason they are bleeding so heavily right now is that they are in the most capital-intensive phase of their life cycle. They aren't taking the cash they generate and returning it to shareholders.
So no dividends anytime soon.
You definitely won't see share buybacks or dividends here. Every single cent, plus whatever debt they can leverage, is being aggressively reinvested into expanding their physical footprint.
And that massive capital expenditure, it definitely explains the brutal net margin. But it also forces the question of allocation.
Right.
Because if all this money isn't just, evaporating on bad management, where exactly is the concrete being toured?
They are building tangible domestic infrastructure at a scale that is incredibly difficult for new entrants to replicate.
Well, the sources outline two major physical expansions that really tell the story here. First, there is a massive 164,000 square foot expansion of their manufacturing campus down in Huntsville, Alabama.
That's a huge facility.
It is. But the development that completely redefines their market reach is a brand new vertically integrated research facility in Indiana.
Right, the biotech hub.
Yeah, this specific facility is entirely targeted at pharmaceutical and biotech demand for microgravity payloads. Let's dig into the mechanics of that for a second, because why do pharmaceutical companies need microgravity in the first place?
It basically comes down to fluid dynamics.
Yeah.
On Earth, gravity causes convection and sedimentation. If a pharmaceutical company is trying to grow a protein crystal to study a disease or develop a highly targeted drug, gravity literally pulls the heavier molecules down.
Which creates flaws, right?
Exactly. It creates flaws and irregular structures in the crystal. But when you remove gravity, like when you synthesize that material in low Earth orbit, you eliminate convection entirely.
Oh, wow.
So the proteins can grow into perfect, uniform, three-dimensional structures. This allows biotech firms to create highly targeted therapies that are just physically impossible to manufacture on the surface of the Earth.
That is a staggering technological leap.
Hmm.
But looking at it through a pure business lens, my immediate thought is to question the vertical integration here.
Okay, why is that?
Because if you are Redwire and your margins are already a catastrophic negative 80%, why build the entire biotech payload facility in-house in Indiana?
Right, you mean instead of outsourcing.
Yeah. Why not design the payloads, license the technology, and outsource the actual heavy manufacturing to third parties to save your balance sheet?
What's fascinating here is how the concept of a competitive moat fundamentally changes when you cross into aerospace and national security.
Okay.
In standard consumer electronics, outsourcing is the default playbook, right? You design a smartphone in California, assemble it overseas, and optimize your margins.
Sure, Apple does it all the time.
Exactly, but space infrastructure, especially when it overlaps with cutting-edge biotech and government defense, it operates under a zero-trust framework.
Because a fragmented supply chain introduces points of failure.
Yes. Security, reliability, and absolute chain of custody are just non-negotiable. By vertically integrating, by completely owning the manufacturing campus in Alabama and the biotech hub in Indiana, Redwire controls the entire domestic pipeline.
Oh, I get it. So they're creating unbelievably high switching costs for their clients.
Exactly. If a defense contractor or a major pharmaceutical conglomerate is going to trust you with a proprietary payload that costs tens of millions of dollars just to launch, they demand to know the security clearance of every single technician who touched a circuit board.
They cannot afford a scenario where, a third-party vendor in some fragmented supply chain uses a substandard bolt that compromises a $100 million mission.
Exactly the opposite of the tech outsourcing model. Structurally, that terrifying cash burn you see on the quarterly earnings report is actually funding a fortress.
That makes a lot of sense.
Yeah, they are building a heavily secured domestic infrastructure that smaller, fragmented competitors simply do not have the capital to replicate. Redwire is positioning itself to be one of the only entities with the cleared facilities required to execute this highly sensitive work from end to end.
So building these secure domestic facilities explains the negative 80% margins. But you don't pour that much concrete, and you certainly don't take on that much financial risk unless you have a guaranteed, highly motivated buyer on the other end.
Right.
And right now, that buyer is the U.S. government, which forces us to look at the geopolitical macro environment because the demand for this secure domestic pipeline is accelerating rapidly.
The broader macroeconomic instability is arguably the most powerful tailwind pushing Redwire's backlog to record highs.
And I want to be incredibly clear with you, the listener, before we dive into this next section.
Yes, very important point here.
We are looking at these geopolitical events purely through an economic lens, just neutrally reporting the facts as they appear in the financial sources.
Yeah.
We are not making moral judgments or taking political sides regarding international conflict.
Right, we are strictly analyzing the economic reality.
Exactly.
Yeah.
Which is that global instability acts as a direct catalyst for defense spending. And the current macro picture is, well, it's severely strained.
Definitely.
We were tracking escalating geopolitical tensions, including U.S. strikes on Iran, an active blockade severely disrupting shipping lanes in the Strait of Hormuz. We were even seeing oil prices being driven above $100 a barrel directly due to this localized instability.
And if we connect this to the bigger picture, supply chain threats in critical regions always trigger a defensive financial posture from global superpowers.
Yeah.
And that posture requires massive logistics and surveillance budgets.
So what does this all mean? When I see oil crossing $100 a barrel and physical blockades threatening international trade routes, my mind immediately goes to panic buying within the defense sector.
It's a natural reaction.
Right, because the military needs guaranteed disruption-proof logistics and communications, which increasingly means space-based assets. Is Redwire's record backlog a direct result of the government aggressively accelerating these contracts to secure their supply lines?
If we connect this to the historical precedent, yes. Macro instability forces the government's hand. When the Strait of Hormuz is threatened, dominating space-based communication and surveillance is no longer a theoretical, nice-to-have science initiative.
It becomes a matter of urgent national security.
Exactly. And the financial sources highlight an unconfirmed, highly speculative rumor that perfectly illustrates this dynamic.
Oh, the Andromeda contract.
Yes, the potential Andromeda IDIQ contract.
Let's break down the mechanics of an IDIQ for the listener, because it's a massive term in defense procurement. It stands for indefinite delivery, indefinite quantity. Instead of the government negotiating a new contract from scratch every single time they need a satellite component, which can take, years of red tape, an IDIQ is essentially a massive pre-approved black card.
That's a great way to put it.
The government sets a ceiling, say billions of dollars, and pre-vets a list of contractors. If Redwire secures a spot on this Andromeda IDIQ, they basically bypass the years of bureaucratic bidding for individual task orders. The government can just point and click to order what they need, drawing down from that massive pre-approved budget.
And securing a position on a major IDIQ vehicle, it transforms a company's revenue pipeline from unpredictable project-based income to highly reliable, rapid deployment task orders.
Which is exactly what they need right now.
Yes. The government requires domestic, secure manufacturing, and they require it immediately. The Alabama and Indiana facilities are essentially custom-built to absorb that exact type of defense demand.
The geopolitical tailwinds make total logical sense. The vertical integration and the defensive moat, they definitely justify the capital expenditure. But here's where it gets really interesting.
Okay, lay it on me.
There is this glaring, undeniable contradiction in the data that we have to confront.
Yeah.
If Redwire possesses this impenetrable competitive moat, and they are sitting on a record backlog fueled by surging global defense budgets, why are the company's own insiders aggressively jumping ship?
Yeah, the insider flow data is the ultimate bear case. And it is a massive red flag for any potential investor.
Here's where the data gets genuinely concerning. Over the past 90 days, company insiders have net sold 11,105,775 shares.
That is a lot of volume.
It is. The Insider Management Sentiment Price Ratio, or MSPR, is sitting at a deeply negative 65.96. To contextualize that for you, over this period, there were only 9 recorded insider buys, compared to 12 massive high-volume sells. There is a very old, very reliable market adage. Insiders might sell stock for 100 different reasons. They want to buy a house, they need to pay taxes, they are diversifying their portfolio, but they only ever buy stock for one reason.
They fundamentally believe the price is going up.
Exactly.
Yeah.
So I have to challenge the entire bullish narrative here.
Yeah.
If the people who have access to the daily internal metrics, the people who actually know the state of the Andromeda contract, are running for the exits, doesn't that mean executives fundamentally believe the stock is overvalued?
It's a fair question.
You have retail investors trying to bravely buy the dip at $8.69 while the C-suite is systematically unloading over 1 million shares onto them.
It is a profound cautionary signal. I mean, the individuals with the deepest visibility into the operational cash flow are net sellers to that degree. You absolutely must factor that into your risk assessment.
Right.
However, to understand the mechanics of why this is happening, we have to look at how this specific stock was structured.
Okay, what do you mean?
Redwire has a very high beta of 3.9, meaning it is wildly more volatile than the broader market index. But more importantly, this is a company that entered the public markets via a SPAC, a special purpose acquisition company.
Oh, And the life cycle of a SPAC almost always involves severe insider selling pressure once the initial lockup periods expire.
Exactly. The mechanics of a SPAC practically guarantee it. Founders and early executives receive massive equity compensation. When those lockup periods finally expire, it is standard practice in high beta growth companies for management to liquidate a portion of their holdings to secure their personal wealth.
Regardless of the company's 10-year outlook.
Right. So a portion of that million share sell-off is likely routine portfolio diversification rather than, a pure indictment of the company's survival.
But routine diversification doesn't negate the mathematical reality of their balance sheet.
It absolutely does not, and that brings us to the actual existential threat facing the retail investor.
Shareholder dilution.
Yes. With shrinking gross margins of 9% and net margins of negative 80%, Redwire is burning cash at a terrifying velocity to finish these facilities. They are heavily reliant on the capital markets or winning massive upfront contracts just to keep the lights on and stay solvent.
If the cash flow from operations remains negative and the debt becomes too expensive to service, they only have one lever left to pull.
They have to issue new stock. They have to dilute the existing shareholder base to raise capital.
Yeah.
And every single new share they print and sell into the open market makes the shares you currently hold worth a little bit less. It is a dilution death spiral that has killed countless heavy industry startups.
So when insiders are selling into this specific environment, it indicates that they are keenly aware of how quickly that cash runway is shrinking.
Definitely.
We have this incredibly stark, volatile contrast here. On one side of the ledger, you have the massive upside potential of the physical expansions in Alabama and Indiana, the 60% hyper-growth revenue, and the geopolitical defense tailwinds pushing government contracts their way. But then on the other side of the ledger, you have a terrifying cash burn, the looming threat of shareholder dilution, and insiders actively selling over 1 million shares. Let's look at how the broader market is currently attempting to price this tug-of-war.
The technical data shows the market is fiercely trying to find an equilibrium, and the battle lines are drawn very clearly on the chart right now.
Well, the stock has established a solid technical floor just above its 52-week low of $4.87. It is currently oscillating and creating a bottoming pattern just under the critical psychological resistance level of $10.
Yep.
And recently, the short-term momentum has flashed positive. It posted a 5-day return of 9.82%. And looking at the news overlay, that specific bounce was directly correlated to the public announcements regarding the Indiana and Alabama facility expansions.
The market saw tangible proof of the concrete being poured, and buyers stepped in.
Right. And the 10-day average volume is heavily sustained at 15.68 million shares, which tells us there is serious liquidity and institutional attention here.
That sustained volume proves that despite the brutal 67% drawdown from its highs, the broader market has not abandoned the thesis. They haven't walked away. They are just waiting for proof.
The sentiment analysis confirms that transition too. The market is slowly shifting from outright bearish skepticism into opportunistic accumulation.
Right.
The aggressive growth investors are looking at that price-to-sales valuation of roughly 5.5, and they are viewing it as a highly attractive entry point for an entity attempting to build a monopoly in domestic space manufacturing.
It essentially boils down to a high-risk, asymmetric opportunity.
Yeah. The market is playing a massive, high-stakes game of chicken with Redwire's management. And the collision point for all of this tension is their Q2 2026 earnings report, scheduled for August 2026.
This raises an important question, and it's one you really have to ask yourself as you weigh the data. What metric actually proves the thesis?
Right.
Because the institutional money, the retail traders, and the algorithms, they are all going to be parsing every single syllable of that August 2026 earnings call. Everything hinges on that specific catalyst.
It is the ultimate moment of truth for the entire execution narrative management has been promising.
The market consensus demands to see two contradictory things happen simultaneously.
Okay, what are they?
First, can Redwire maintain that aggressive 50% plus top-line revenue growth? And second, and arguably far more importantly, can they finally demonstrate tangible gross margin expansion?
Oh, I see.
If management can provide hard numbers proving that the Alabama manufacturing campus and the Indiana biotech facilities are transitioning from cash-burning construction projects into efficient, high-margin revenue generators, then the execution narrative is validated.
And if they achieve that, the stock has massive technical room to run back toward its previous highs because the geopolitical demand for the product is undeniably permanent.
Absolutely.
But if they fail to show that margin expansion in August,
If the revenue growth stalls, or if those catastrophic negative 80% margins refuse to budge, the market's patience will instantly evaporate.
Wow.
The market will punish the cash burn. The threat of shareholder dilution will become an immediate reality to keep the company solvent. And that technical floor of $4.87 will be tested and likely broken very quickly.
It truly is the ultimate high-risk, high-reward bet in the modern space economy. To synthesize the massive amount of data we've unpacked for you today, we are basically looking at a company trading 67% below its peak valuation, yet miraculously scaling its revenue at nearly 60% year over year.
It's crazy.
They are armed with brand new, vertically integrated, state-of-the-art facilities dedicated to microgravity biotechnology and secure defense manufacturing. And they are backed by powerful, long-term geopolitical tailwinds.
Right.
Yet at the exact same time, they are battling a brutal cash burn, heavy insider selling pressure, and the ever-present shadow of shareholder dilution. It all really comes down to whether they can prove their operational efficiency in August 2026.
It is the perfect encapsulation of the growing pains the entire space industry is enduring right now.
Yeah, it really is.
Transitioning from theoretical science to heavy industrialized manufacturing is just an incredibly expensive, high-stakes evolution.
Which brings me to a final thought I want to leave you with, something for you to mull over as you watch this entire sector evolve over the next decade.
Okay.
We started today by talking about how space infrastructure has moved from science fiction to a highly volatile, capital-intensive reality, right?
Right.
But let's look one step further down the timeline. As domestic, vertically integrated space manufacturing becomes increasingly inseparable from vital national defense networks and breakthrough pharmaceutical biotechnology, could companies with these massive cash burns eventually be viewed completely differently by the broader market?
That's an interesting thought.
Think about it. What happens to standard financial valuations when base infrastructure stops being treated as a speculative tech bet that needs to show quarter-over-quarter profitability and starts being treated as an essential public utility? What happens when manufacturing payloads in microgravity is viewed as fundamentally necessary to national security as, say, the terrestrial power grid or the interstate highway system?
Right.
Because if that psychological shift in perception happens, the entire mathematical model we use to value a company like Redwire might have to be rewritten from scratch.
It is a fascinating paradigm shift to consider. I mean, we don't ask the Hoover Dam to show a 20% net margin every quarter, right? We just need it to guarantee the lights stay on.
Exactly. The science fiction era is officially over. Now, the market just has to figure out who is willing to fund the reality.